Hey everyone, this is Joseph. So the big news today seems to be about Silicon Valley Bank. I used to study banks, so I thought I would offer a little bit of insight as to what might be going on. Long story short, Silicon Valley Bank is obviously not going to make it and will probably be sold over the weekend. That being said, it's very, very unlikely that there would be a financial crisis in the banking sector. So we tend to interpret events based on our own experiences. And for many people today, one of the defining experiences is what happened during the Great Financial Crisis, which was basically a banking crisis. So when they see things happening in the financial sector, and especially the banking sector, the temptation is to think this is Lehman all over again. But since then, there have been really big structural changes in the banking sector. One, because of central bank actions, there's a lot more liquidity. And two, the regulations today are much, much more stringent than before. So it's very difficult for there to be a repeat of Lehman today. What's probably happening is that you have a few banks that are not super well run and they're going to disappear. Let's look at what's happening with Silicon Valley Bank as an example. So, in an abstract sense, a bank is a business that's primarily trying to solve two problems. So a bank is concerned about, one, its solvency, and two, its liquidity. A bank basically borrows short and lends long, as we all know. So if I deposit $1 million in my local bank, then my local bank owes me $1 million. I can go and I can withdraw that anytime I want. That's the bank borrowing short. The bank, though, also makes loans. The loans are oftentimes longer dated in tenor. For example, maybe a 5-year loan to a local business. Now, the solvency aspect is making sure that the bank's assets exceed its liabilities. Now, as long as that's the case, the bank is solvent, and so I don't actually worry about going to the bank and the bank not being able to pay me back because it doesn't have solvency. Basically, its assets are worth less than what it owes me. Then I'm in trouble and maybe I will lose some money. But the more common problem a bank faces is liquidity. So going back to the example that I just discussed, let's say I have $1 million on deposit at the local bank. The local bank makes a whole bunch of loans, but they're all, let's say, 5-10 years in tenor. So if I go and I ask for my $1 million back, the bank, it has good loans on its books, but it doesn't have the cash on hand. It has a liquidity problem. Now, I don't have insight into the loan book of Silicon Valley Bank, although I suspect, based on what I read in Bloomberg, it's probably an insolvent bank. But it's also very clear that it has a huge liquidity problem. Now, let's look at the asset side of the bank first. So when you want to study a bank, what you want to do is you want to look at their regulatory filings, their call reports that they file quarterly. So the call report is what you see here. It's literally a regulatory form that is over 100 pages in length. And if you want to understand what the items are saying, it also has an instruction manual that is literally 800 pages in length. So it's a really difficult document to understand, which is why I keep a copy by my desk. When a bank in order to meet withdrawals, redemptions, and so forth, a bank always has to have some liquid assets on its balance sheet. That could be cash in the vault or cash held at the Fed, bank reserves. In practice, a lot of banks like to hold high-quality liquid assets like treasuries or agency MBS as their liquid assets. You earn a little yield on these securities. And so here, I'm showing the high-quality liquid asset holdings of Silicon Valley Bank. Now, let's see if I can move this a bit. There. Okay. So this is based on their regulatory filings. And based on their regulatory filings, Silicon Valley Bank owns about $120 billion in securities. Securities are more liquid than loans, which are basically not liquid. So But among the securities they hold about 80 billion in what's called high quality liquid assets. These are liquid assets that don't have credit risk and are more easily able to monetize, specifically treasuries and agency MBS. So here we see that, if you add it up, in their held to maturity and available for sale columns, they have about $80 billion in high quality liquid assets. And that's a lot. Now, for reference, they are a bank with $210 billion in assets. So if of those assets you have 80 billion, that's liquid, high quality liquid assets, that's really good. It's a really liquid bank. But then if you take a little bit, if you look at the next page in the regulatory forms, what you see is that actually maybe it's not as good as it seems. So this shows that a lot of the high quality liquid assets have actually already been pledged. So they're already using it for some sort of liquidity. It's possible they haven't drawn down on that, but it's possible that they have as well. So this regulatory report is dated year-end 2022. And things have gotten worse since then. So it's very likely that even more of their 80 billion in liquid securities is already pledged. This is a problem because it's possible that if a lot of people ask for their money back at the same time, they won't have enough liquidity to meet that, to meet those redemptions. One thing that we read in the news is also that they've actually sold some of their securities at a loss potentially to meet outflows. And that's really not a good idea, since that realizes losses. So that shows that they might be having some problems getting either borrowing money from new investors or borrowing from the home loan banks, which we will talk about in a bit. So in looking at whether or not they have a liquidity problem, it's not just about the asset side of the balance sheet. It's not just about seeing if they have a lot of high quality liquid assets, which they do, but it looks like a lot of them have already been pledged. It's also about looking at the liability side. So when a bank borrows money from an investor, there's a whole different types of borrowings the bank can have. The bank can issue term debt, for example, which is not runnable because, when you have a term debt, let's say you borrowed money, you don't have to repay it for a contractual period of, say, 2, 3, 4, 5 years. So you don't have to worry about someone showing up at the bank and trying to withdraw their money. You can also have retail deposits, which are also very stable. So if you are a retail investor, usually you don't, you're not too worried that the bank would go under and lose all your money because you have FDIC insurance. In the US, bank deposit accounts are insured up to $250,000 in insurance. So retail depositors are very sticky. They're not likely to go to the bank and ask for their money back because they are covered by insurance. In the call reports, we see that the Silicon Valley Bank has $150 billion in uninsured deposits. Now, that suggests that a lot of their depositor base is institutional investors. If you have like $10 million, well, obviously that far exceeds the $250,000 FDIC insurance limit. So the rest of that, the $9,750,000 else of the $10 million deposit would not be insured. And it looks like a lot of the people who lent money to Silicon Valley Bank are not insured. And for them, it's a really big problem if Silicon Valley Bank goes under because, they are a creditor to Silicon Valley Bank. And if Silicon Valley Bank goes under, they could lose everything. They probably won't, but they're going to lose money. And when you put money in the bank, you don't expect for it to be at risk. And so you really don't want to take that risk. So if you are a depositor in Silicon Valley Bank and you're reading all these headlines, you're watching their stock go to zero, you want to get your money out ASAP, which I believe is happening right now, if they can. Okay, so we've talked about the liquid assets that Silicon Valley has and their more flighty depositor base. Now let's put ourselves in their shoes. So we're having a run we're running out of liquidity, what do? We can, of course, go and borrow more money. At the end of the day, we could borrow from the Fed through the discount window, but that's definitely not what we want to do. Because if you go and borrow from the discount window, then people know you're really in trouble and you can exacerbate the outflows. So usually what would happen is you would go to the next lender of last resort, which is a federal home loan bank. The federal home loan banks are government-sponsored enterprises that are basically chartered to provide cheap funding to commercial banks. So we can see here that the Silicon Valley Bank has already borrowed $15 billion from their local federal home loan bank. Now, the question is, can they borrow more? In theory, if you look at the credit policies of the federal home loan banks, yes, they can borrow more. But there are also a lot of other things involved as well. So $15 billion is the amount of capital the Silicon Valley Bank has. And of course, it's possible that Silicon Valley Bank is also insolvent. So even if technically under a credit policy, the Federal Home Loan Bank can lend more money to Silicon Valley Bank, there might be some other regulations that kind of discourage them from lending to banks that are in a poor condition. And I think this is especially true in the case of the Federal Home Loan Bank of San Francisco, which is the home loan bank that made loans to Silicon Valley Bank. Now here, this is a filing of the loans outstanding by the Federal Home Loan Bank of San Francisco. What you'll notice is that they're actually already very exposed to Silicon Valley Bank. In fact, Silicon Valley Bank accounts for about 20% of their entire loan book. So if you are a home loan bank, and as a historical fact that home loan banks have made loans to banks for many decades, and they have never ever had a single loss. So they're very conservative, the loans are secured. But I imagine if you are a credit officer or CEO of Federal Home Loan Bank of San Francisco and you're looking at Silicon Valley Bank, you're thinking that they're going to go under, you're seeing that you're already exposed to them, 20% of your loan book, it's not a wise decision to just, further your exposure. So it could be that Silicon Valley Bank can't borrow any more from the home loan banks. So if you can't borrow from the home loans, and you obviously can't borrow from the market, since that's what we're reading in the headlines, at the end of the day, you could potentially borrow from the Fed, or you could just get bought by someone else. So that looks like what's going to happen with Silicon Valley Bank. So there are probably other banks like this, but so far it's very unlikely to be a financial event. So anyway, I hope you found this short video helpful. So again, my name is Joseph. I write and teach about the markets. If you're interested in learning more about the financial system, I have a best-selling book here, Central Banking 101 on the financial system. And if you're interested in learning more about the markets, I also have an online course called Markets 101 that teaches about markets from the perspective of a macro trader. You can find all this on my website, fedguy.com. Thank you, and I'll talk to you all soon.